In today's video, we break down the supply and demand trading strategy and connect it to the broader liquidity concept in trading. Rather than treating it as a simple support and resistance trading strategy, we approach it as a structured execution model based on real order flow and market behavior. You will learn what supply and demand zones represent, how they influence price, and how to mark them correctly within key trading concepts in the stock market. Welcome to the ComLucro channel. By the end of this session, you will know how to identify strong supply and demand zones, filter weak setups, and apply this strategy with precision using single and multi-time frame confirmation. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Let's begin with the basics. In the market, every price movement is driven by the balance between buyers and sellers. When demand is greater than supply, price moves up because buyers are willing to pay higher prices. When supply is greater than demand, price moves down because sellers are willing to accept lower prices. So what exactly are supply and demand zones on a chart? A demand zone is an area where buyers previously stepped in with strength and drove price upward. In contrast, a supply zone is where sellers entered aggressively and pushed price downward. These areas matter because the market often reacts to places where strong buying or selling occurred before. When price returns to a supply zone, sellers may become active again, increasing the probability of another move lower. Likewise, when price revisits a demand zone, buyers may re-enter the market and push price higher. In simple terms, demand zones function as potential support, while supply zones act as potential resistance. They highlight areas where price is more likely to react instead of moving randomly. However, the key is to focus on zones formed by strong, decisive buying or selling, not slow and sideways price action. High-quality zones are typically created by impulsive moves that reveal a clear imbalance between buyers and sellers. To make this more objective, we need clear criteria. For example, we can require 3 strong green momentum candles to classify an area as a demand zone. In the same way, 3 consecutive red candles with large bodies and a strong push downward can define a supply zone. The idea here is simple. We want evidence of real participation and strong interest, not just small, random fluctuations in price. Now that we understand that, the next question is how to correctly mark the supply and demand zone on the chart. Traders may use slightly different techniques, but one principle remains the same. We focus on the area where the impulsive move actually began. Identifying that starting point depends on how the candle is formed. So let us walk through a few common ways to mark these zones clearly and consistently. Here, for instance, we see the most recent impulsive move to the upside. This strong green candle is the origin of that expansion. Because the decision to push price higher happened during this candle, we mark its range as the demand zone. When price eventually comes back into this area, we anticipate some form of reaction within that zone. Another widely used approach is to mark the last red candle before the bullish expansion. This candle represents the final selling pressure before buyers took control. Once price breaks above that prior supply, the area effectively shifts into demand. So when price revisits this zone, we expect buyers to respond again, potentially leading either to a rejection or a continuation to the upside. In this specific example, the choice of candle is not critical because both candles cover nearly the same price area. However, that is not always the case. In some situations, the candlestick structure clearly determines which zone is more valid. For instance, if we mark only the first red candle as the start of the bearish move, the zone becomes very small and may not accurately represent true supply. In this case, marking the last green candle before the drop provides a broader and more meaningful supply area. On the other hand, there are situations where the first red candle offers a cleaner and more reliable supply zone. It all depends on how the move unfolds and how price behaves afterward. The structure of the expansion and the reaction that follows will often guide you toward the better choice. Another key element to consider is the wick. In this example, the demand zone is drawn from the wick because that is where price was strongly rejected and the impulsive move actually began. The expansion did not originate from the first green candle or from the previous red candle. It started at the lowest point of the wick, which defines our demand zone. Wicks are powerful price action signals because they reveal areas where the market rejected lower or higher prices with strength. When we mark these levels properly, we increase the probability of a future reaction if price returns to that zone. With all of that in mind, here is an essential reminder. No matter how precise your supply and demand zone is, a perfect rejection from that exact level is never guaranteed. Sometimes price reverses before reaching the zone, and in other cases, it retraces deeper than expected before reacting. So the next logical question is this: how do we avoid missing trades and unnecessary stop-loss hunts? One practical way to reduce missed entries is to place your order slightly above the beginning of the demand zone, by about the size of the spread. That way, even if price only taps the very edge of the zone and quickly rejects, your buy limit can still be triggered. To reduce the risk of stop-loss hunts, you also need to adjust your stop placement according to the size of the zone. If the demand zone is small, give your stop a bit more breathing room below it. If the zone is larger, a more balanced approach is to enter closer to the middle of the zone and place your stop safely below the entire area. Up to this point, we have covered what supply and demand zones are, the psychology behind them, and how to mark them correctly on the chart. Now we move to the most practical part of all: how to actually trade these zones in a structured way. We will go through two straightforward strategies. The first one uses a single time frame, and the second combines two time frames for additional confirmation. Let us start with the single time frame supply and demand entry. This approach follows a clear and simple sequence of steps. It can be applied to any market and on any time frame. The first step is always to identify the overall market direction, because trading in alignment with the trend increases probability. So let us begin with a quick and practical way to determine that direction. When price creates a clear 1, 2, 3 pattern and then breaks out, that structure defines a trend. If price continues by breaking above the most recent swing high, it confirms continuation. As long as price remains above the latest protected swing low, the market stays in an uptrend and our bias remains bullish. If another breakout occurs to the upside, we then mark the lowest point that led to that breakout as the new protected swing low. And again, as long as price respects that level, we continue looking for buying opportunities. However, if price breaks and closes below the protected swing low, that signals a change of character. In simple terms, buyers failed to maintain control of the structure, and sellers are beginning to take over. That shift suggests a potential reversal. From that point forward, we can shift our focus to identifying fresh supply zones and preparing for possible short positions. Once direction is clear, step 2 is to mark supply or demand zones according to the rules we covered earlier. In this example, the market direction is bullish, so we focus only on demand zones and buy setups. Mark the most recent valid demand zone, place a buy limit at the beginning of that zone, and position your stop loss below it. If the stop is also below the protected swing low, that is even better, as it typically provides stronger structural protection. For take profit, aim for the next significant level in front of price. But before finalizing the trade, pause and evaluate one critical factor. How much room does price actually have before reaching the next key level on the higher time frame? For example, in this scenario, imagine we zoom out to a higher time frame and notice that price still has significant space before reaching the next major level. In that case, entering the trade makes logical sense because there is room for price to move. Now consider the opposite situation. If price has just tapped into a strong, higher time frame resistance area with clear reversal potential, taking a buy trade becomes much riskier. In that environment, it is usually wiser to wait for confirmation or shift your focus to possible selling opportunities instead of forcing a long position. So, that covers the first strategy. It is clean, straightforward, and effective, relying on a single time frame. Now let us build on that foundation and move to strategy number 2, where we combine two time frames to increase precision. On the higher time frame, we follow the exact same principles we discussed earlier. The only difference is that we refine our execution by dropping down to a lower time frame for confirmation and entry. This approach can be applied to any market and does not depend on a specific time frame. The key rule is simple. Your execution time frame should be roughly 2 steps lower than your higher time frame. Here are a few practical combinations based on trading style. For instance, if your higher time frame is the 4-hour chart, you can drop down to the 15-minute chart for execution. Now, let me walk you through how this works in practice. The first step is to identify the overall trend and mark the relevant supply and demand zones on your chart. At the same time, analyze the higher time frame structure to measure how much room price has before reaching the next key level. This helps you avoid entering trades with limited potential. Next, be patient and wait for price to retrace into your selected zone. Do not enter prematurely. The market frequently sweeps early entries and uses them as liquidity before making the real move. So the rule is simple. Let price reach your demand or supply zone first. Once price taps into the supply zone, shift to the lower time frame to look for confirmation before entering a short position. On this lower time frame, you may notice a clear uptrend, which represents the corrective move within the higher time frame structure. What we want to observe is a loss of strength inside the supply zone. In practical terms, we look for signs of rejection or evidence that the lower time frame uptrend is beginning to weaken. There are several valid triggers you can use for confirmation, such as a strong wick rejection, a break of a trend line, or even a change of character. In this particular example, however, we are looking for a liquidity grab inside the supply zone. A bearish liquidity grab happens when price briefly breaks above a previous high, but quickly returns back into the range. This tells us that buyers failed to sustain the breakout, and the move was likely a trap. At the same time, liquidity resting above the swing high has been swept. After this type of behavior, the probability often shifts toward a stronger move to the downside. In the same way, a bullish liquidity grab forms when price breaks below a previous low, but quickly moves back inside the range. This behavior shows that sellers were unable to sustain the move lower, and the market immediately rejects those lower prices. As a result, liquidity resting below the swing low is taken, and momentum begins to shift in favor of buyers. When this sweep happens inside a higher time frame demand zone, the probability of a stronger move to the upside increases. Both bearish and bullish liquidity sweeps tend to be more reliable when they occur within higher time frame supply or demand zones. That higher time frame context adds weight to the setup and filters out weaker signals. So how do we execute the trade using this approach? Start by drawing a line from the tip of the wick at the most recent swing point. If price pushes beyond that level, takes the liquidity, and then closes back inside the range, that close becomes your confirmation. At that moment, you can enter the short position, place your stop loss above the swing high, and aim for the next significant level ahead of price as your target. And above all, remember that context and patience matter. Focus only on high-quality setups, control your risk carefully, and never force a trade. When you apply these principles consistently, supply and demand trading can become a structured and reliable part of your overall strategy. So traders, supply and demand trading is not about drawing random zones and hoping for a reaction. It is about understanding imbalance and structure. When you combine clear zone identification with trend alignment and disciplined risk management, you move from guessing to executing with logic. Stay patient, focus on quality setups, and let the market come to your levels to build consistency over time. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, technical analysis for day traders, trading psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.